Well, I think diversification is a very good true north. I mean, I really do. But when I started my career in real estate, it was as a passive investor. That was the place I was in. My goal was to help my mom get her money out of the stock market. As a passive investor, diversification is a very prudent and noteworthy strategy.
Hunter, welcome back to the show.
Hey, it's an honor to be on. It's been a long time and it's great to be on. It's awesome to see your growth, by the way. Congratulations to you and the team.
Yeah, thanks so much. Catch us up on what's been new with you, Hunter.
A lot. So last time I was on was years ago. I've really been through quite a lot. For those that are new to me and haven't been using any social media whatsoever, because I've been trying to show up on your social media. If you're not familiar with me, trust me, it's not for lack of trying. Basically, I started my career in 2011 or so, and my first kind of true north in this industry was diversification. I wanted to find great operators in different asset classes and defer to their expertise. And I really saw an opportunity in the capital raising space in particular. And so I initially found an operator that had done $100 million of multifamily and mobile home parks and partnered with them through a fund of funds vehicle. I didn't know it was called that, by the way. I just created an entity to invest in their deal. And that was kind of the first time I went out to raise money. If anyone has read my book, I failed miserably on my first capital raise, and that was kind of embarrassing, but eventually I figured it out and built a business where we raised tens of millions of dollars for other people in different capacities through fund of funds. I also did it through a broker dealer at one point, also through co-GP models. And to be honest with you, as you grow up as an entrepreneur, you uncover things, you gain more confidence, you don't maybe have as many of the same imposter syndromes and limiting belief feelings you used to feel. And so I went from focusing all my efforts on diversification to just going hyper focused all in on one asset class in one geographic location, not necessarily as a capital raiser, but as a GP, which people say, a general partner. And we just do this now just in Phoenix, Arizona, multifamily. And so that's kind of been what I've been up to in terms of the capital raising and private placement side of things. And that's been a big change in our business, but it's been the right move at the right time. And I think the market, which we'll talk about, is just prime for people to go all in on multifamily right now.
Before we get to that, there's a lot of, especially people who come from the more capital raising space, they end up diversifying, and they did a little bit of opposite of what you're done. They're going to start raising money for this and this oil fund and that thing. Why did you kind of from that and kind of go back to focusing from where you're investing perspective? What was problematic, if you will, or what didn't you like about that?
Well, I think diversification is a very good true north. I mean, I really do. But when I started my career in real estate, it was as a passive investor. That was the place I was in. My goal was to help my mom get her money out of the stock market. And so, as a passive investor, diversification is a very prudent and noteworthy strategy. But as you start to grow and develop skills and you want to own and control the entire thing, you usually make your way to being a general partner. And when you're a general partner, diversification is not the true north. It is hyper specialization and everything that comes along with that, meaning things like rinse and repeat, using the same relationships, using the same software, using the same property management company, even vertical integration, material rinse and repeat. So that's the kind of thing where a lot of people go through this transition where they start as an LP and then they get into it and they start building relationships and they start having due diligence processes that are well above and beyond what a normal LP might do. And so the obvious trajectory is for them to become a general partner. But when you're a general partner, the true north is very different than as an investor in the traditional sense. You want control. And in order to get control, you can't control everything at all times. You can only control very few times. And so few things at the same time. And so that lends you towards hyper specialization and really the opposite of diversification.
Now, what about the middle thing? Middle thing as a fund manager, right? A fund manager is obviously someone who creates her own fund, raises money, and then basically invests with an operator. And those are
Yeah.
the kind of people that I see some diversification. You've chosen we've done that we are multifamily operators, and that's I don't know, good thing, bad thing, I don't know. It makes us an expert in one space, but it also doesn't make us a destination for diversified investments, right? So
Yes.
what is your thoughts on that fund manager career track for you?
Well, I think it's freaking awesome, to be honest. And I'm maybe this maybe seems like self obsessed or something. I'll say that I think I played a role in the creation of that part of the industry. Not that I'm like the person that invented fund of funds or anything like that, but I certainly played my little role in that little tiny strategy. And the reason for that is that I kind of stumbled upon it on my own in 2014. Now, there's some people listening to this and being like, 2014, what are you talking about? Fund of funds have been around forever. Fair point, but not in the same way, in the same popularization of our world and syndications. And so the reason I'm a big proponent of it is that it's a great way to hybrid your way to being a GP. And if you are a GP, it's a great way to get diversification outside of your area of focus. And so I still think it's extremely valid. It's just a tool that you have to use carefully. Now, when you are a fund of funds manager, I wouldn't say diversification should be the true north. I would say that the true north is, hey, listen, only partner with people that you want to really partner with. I mean, only marry people you want to marry with. I mean, these are illiquid investments that are being held 5 to 7 years. I think I over indexed in the initial part of my career for diversification when I should have over indexed for integrity, relationships, simplicity. And so, we all make mistakes, but my goodness, if I'm looking at a portfolio, I think a portfolio of an accredited investor should include stocks and bonds for their liquidity, but should also include things like multifamily, self storage, mobile home parks, and maybe some retail if you want to get into some stuff like that. But you don't have to go much further than that. And so rather than find 30 operators you want to work with, maybe the goal should be find 5 you want to work with for the rest of your life. And that's the lens through which to view the fund to funds management stuff. That's my perspective, at least.
If you are a fund manager, and this is something maybe you don't even want to bridge it into a GP, but you just want to be a fund manager and say, hey, this is the path I want to go down because it seems like a great opportunity. I get to become my own fund manager. Like you said, go narrow with a few operators that you like. How do you really vet those operators in your opinion? Like what does one have to do as a fund manager to pick those right partners?
Well, number one, let me just kind of correct myself. It's not only a good way to hybrid your way to being a GP. It's just that's a very common path for people that want to be a GP in today's climate. It is also a very viable and very scalable business. And I know this because we raised around $50 million as a fund of funds manager. And so going back to your question, how do you vet operators? I think first things first is that's the lens through which you view this conversation. If I'm going out to look for operators, I'm going out to look for partners that I truly want to be with, not just for one deal, but for 10 over the next, 5 years, and then over the next 5 years, and then over the next 5 years. And so I look for character, integrity, and things like that. Now, everyone says that, right? So the technical side of things is how do you do that? And it comes down to reading between the lines. Most importantly, is the operator putting themselves in a position to deliver on their promises, or are they selling the dream to get the deal closed? And so you can do this from a very technical standpoint. Like one thing fund to funds managers should be doing is looking at the trailing 3 financials, looking at the trailing 12 financials, and then comparing that to the year 1, year 2 financials and projections, and kind of asking questions about the major differences between the two. And so as you go through that process, I mean, most LPs aren't doing that. Today it's more common, but as a fund of funds manager, you absolutely have to be asking those questions. And as you do that, you're going to find how conservative or aggressive the sponsor is being and how much of this is rinse and repeat versus a new business plan. So I'll give you a perfect example, right? So we have a property that we're under contract to buy. It is in the only market we work in, Phoenix, Arizona. It's a 1979 type of deal. The last property we bought was a 1975 deal. Very similar vintage, very similar size, very similar price per door. It's 4 miles away. The other property is, 57% above projections. Past performance is not indicative for future results, but that's the truth of it. To me, that's very different than we're going to go to Dallas for the first time and buy our first 1992 deal in Dallas in a market we don't know, in a submarket we've never done a deal in. That's just, there's so much uncertainty with that. New relationships, new software, new property management, new submarket, new surrounding submarket. Like that is just, it's very telling if the operator can answer a question the former way versus the latter. And as you go further and further, you'll uncover more and more things, but that's a pretty obvious one I think all investors can wrap their heads around.
You said earlier to now might be a great time to get into the investing game passively into real estate, multifamily, self-storage, that kind of thing. What makes you say that?
I mean, look, I'll start off by saying this. I'm disappointed because for the last 10 years, in particular the last 5, I heard so much conversation around, I can't wait for there to be a pullback. I can't wait for there to be a recession. God, give us a 20% reduction. And then the moment that the market hesitates, let's call it 2020, right? When the markets froze, essentially, everyone goes, not like this. This doesn't count. This is insane. There's a pandemic. There's government lockdowns. This isn't what I meant. And I was going, yo, that's what it takes to get 20% reductions in multifamily. Now, what happens in that case was that there wasn't any reduction. Deal flow
Right.
dried up for a little bit. Everything came up. There was a lot of money printing and some stimulus, and rents went up, and it was basically an explosion. But then they forgot so quickly that now we have real distress in the market. Then 2022, interest rates start to rise. They go on to rise faster than they've risen in 40 years, and people do it again. This doesn't count. This is a black swan event. Who could have predicted the Fed would raise rates faster than which is true. I wouldn't have predicted that. I didn't predict it. I talked a lot about how I thought interest rates would go down to the right. My point is, this is what it feels like to have an opportunity to buy distressed deals. And everyone's been saying survive until 25. Here it is. And it's like me and 5 other people that are screaming, this is the opportunity. And you know it's an opportunity. Why? Because when I go to raise capital, well, you start hearing things you hadn't heard in forever, which is, oh, 70s product? You guys are buying 70s product? Sounds a little old to me. Oh, it's 100 units. I like to buy 200 units. That's when you know you're getting a good deal. When the market starts to hesitate. And that's what's going on right now. We're doing a raise right now, and you're doing Phoenix? Aren't you guys running out of water? Those conversations that were never happening now happen. And that's how I know the GP economics and the LP economics are going to be quantum different than a couple of years ago. And so I'm sure you're familiar with that and sympathetic to that view, but it's
We
it's
are.
how the market messes with your mind.
Yeah, the challenge is I feel like we're collectively as passive investors going to miss a major opportunity, right? Because of this thing. Oh, we got our butt kicked a little bit. That was bad. We probably shouldn't do that again. But why is that? And on the other hand, there are a certain class of sophisticated investors who are trying to understand what has happened and what the outlook is. And they are incidentally, interestingly, starting to come back now, right? So how does one look at what's happened and what the outlook is with a more discerning eye? What is it that you think is different now than it was 2.5 years ago?
I mean, it's wild, right? And this is how it will play tricks on you. And let me just be honest about this. When I got into this business, I'm in my late 20s or mid 20s. I come in and I start getting into the world of investing, and I think this is gonna be easy. I mean, buy low, sell high. What is wrong with everyone? And so you look at the chart to go, obviously, buy in 2010. And so now that I'm a little older and I've been through distress, I know a little bit more about how this can possibly happen, but it creates the opportunity, right? And so let me provide context. Everyone knows multifamily is the darling of private equity. There's a reason institutions invest in multifamily. There's a reason agencies love to lend on multifamily to a degree that it's not even close to any other asset class. And so the metrics that use to track how well a multifamily deal is going to do are publicly available. Supply demand is publicly available. Population growth, income growth. This is publicly available information. This isn't some unique proprietary algorithm that Michael Blank figured out a couple years ago. And so what
It's
ends up
not.
happening is the listeners go, oh no. So what ends up happening is that it's competitive. And so people compete, and they're willing to pay more and more. And as interest rates trick down and down and down, and cap rates go down and down and down, the risk that you need to take to make deals pencil now includes floating rate debt as you go into 2020, 2021, 2022, especially if you're buying in prime markets where this data is so compelling, you just can't believe it. And so people were willing to take that risk. And myself included, I invested in many deals that had floating rate debt. And so what ends up happening is that when interest rates rise faster than almost any bond billionaire would predict that they would, including any institution and any bank, it creates distress in the market. And so it's okay to say that if you lost money on a deal, for example, most LPs are now knowing that there's a material difference between buying deals with fixed rate debt and floating rate debt. And there's a lot of other metrics out there that can make deals risky or not. But if you look at every single metric, it is cranked down in terms of risk than it was in 2022. You can buy deals in Phoenix, for example, and in other markets with fixed rate 5-year financing. You can buy deals with sub 70% loan to value. You can buy deals that you don't actually have to implement a massively risky business plan. Like you don't have to renovate units in some market. You can just buy based on distressed current numbers and data points. And so that to me is like every metric is turned the other way. But it only is possible when there's hesitation in the market. And earlier I was kind of talking tongue in cheek about me being disappointed. Some people are like, Hunter, I want to go all in right now. I want to go left when everyone's looking right, but I'm getting squeezed financially. And that's one of the many things that happens during a correction is that the liquidity dries up. And so you still got to go freaking all in because you don't even have to do many deals in this climate to make it very much worth your time. That's true as an LP, and it's certainly true as a GP as well.
Yeah, I couldn't agree more. I think you're in this period of time where it's not just interest rates squeezing. You've got rents that are going down because of oversupply from COVID. You've got insurance that's higher than it's ever been. You've got taxes that have gone way up. Your payroll has gone way up because of inflation, along with other expenses. So the squeeze is there, but you're seeing this price retraction that's so significant from the peak, which was March of 2022, that you can't ignore it. And so when people are like, you're coming to me and they're like, well, I would invest, but 6% cash on cash doesn't seem like a lot. I can get 5% of my money market. It's like, yeah, you could, but you're going to pay taxes in the money market. Whereas you have some tax cover in the real estate deal, and you're really giving, which the trade-off is that you're getting lower pricing, where I think that there's more upside potential from the equity that you can clip on the backside because of how far things have fallen. Because you got all these forces that are driving prices down right now. And so that's when you should be going in now. Is it harder? Yeah, it's hard. As a GP out there, you got to keep trying. It's hard. I think the hardest part is to forecast what's out there. Right. So I'm curious about that, Hunter. You guys are in a deal now. How are you guys looking at like the future? Like what kind, like cap rates or anything specific? What does that outlook look like?
So obviously, and please don't take this as like being biased. I'm just talking about Phoenix because that's all I know now.
Yeah.
Right. So like,
Yeah.
please
I'm out
understand.
here, by the way.
Okay, cool. Makes sense. All right, so good. So hopefully you'll back up some of my claims. And if you disagree with me, trust me, I want to know because I'm basically betting my career on Phoenix right now. So like, please bear with me. Look, the thing that people talk about with Phoenix, we've talked about the water thing. It's not really a major risk. Some of the largest Fortune 500 companies are moving there. They're moving their headquarters there. The largest international investment of all time is taking place in Phoenix. These companies do research about, water and et cetera. So we can just put that to a side. So Phoenix is a market where you can develop units. And the reason it's a market where you can develop units is that it's a very low regulation state. Okay. This is a buzzword that people need to understand. When you hear high supply market, cue it in, which is that there's going to be less regulations, which means it's going to be way more friendly to investors and people that want to create and have jobs. So you can buy markets where there's constrained supply. But the reason it's constrained is almost never because of the physical layout. It's almost always because it is a high regulatory environment. And regulation is very difficult to predict and is kind of binary. You either get the regulation or you don't. It's not something I really want to mess with. So in Phoenix, you can predict population growth, job growth, income growth, and to some degree, rent growth, because you can see it takes around 2 to 3 years to develop and then stabilize assets. And so you're kind of able to use these charts and graphs to your disposal. So to answer your question, right now, and this is just from our data in the portfolio we have, is that we believe that we've kind of touched the bottom in Phoenix and now are trending up and to the right. And this is true for occupancies. This is true for concessions. This is true for rent growth. But even so, we still have another year or two of things working itself out before we get back to what we think is going to be hyper favorable for owners, and particularly 2027. So to answer your question directly, the deal we just closed, we're projecting 0% rent growth for year one, right? Even though the submarket experienced around 4% for the last 12 months. So like that to me is so compelling because you just know that kind of underwriting is not going to last. In 3 years, I'm not going to be able to come on this show and be like, we're so conservative. We put 0% in. Why? Because we would not be able to buy the deal at the basis that we bought it in if we put that in, unless our cost of capital is like 2%. So my point is, we're trying to buy assets when there is hesitation, because by the time 2027 rolls around, the development has fallen off in Phoenix dramatically, starting in 2025, second half of 2025, 2026. And then at that point, there's not like this new wave of development to take place, because if it was going to happen, we would have to see the permits and these things would have to start now. They'd have to be breaking ground now, and they're not. They've dropped off by 80 to 90%. So that's the game we're playing, and it's not the only game we're playing. We want to be very good on operations and, squeezing every single dollar. If we didn't need to do these property specific meetings every week. But that to me is the big tailwind that's going to be in our favor in about a year and a half or 2 years.
And what I hear a lot is, especially from new investors, they're like, "Oh, I'm just going to wait. Let me just wait. I don't want to get into it right now. Let me just wait a year, because why waste a year and get into something, right? What is your why'd you do this deal now? Why not just wait a year until you can project 2% rent?"
So one thing I'll just to be fair about this, and then I'll tell you the real answer. Number one, you're never going to miss the opportunity in real estate. It's not possible. It's too good. I mean, that's the reality of the situation. You're never going to miss the thing, because the thing itself is so good. As long as you're playing the game, so if you listen to this in 8 years, now's a great time. You know what I'm saying? But from my perspective, all it goes back to those metrics we were just talking about. I know for a fact that when someone goes to buy a deal in Phoenix in 2027, they aren't going to be able to take all those metrics and crank them down like they're currently cranked, AKA, 70% loan to value, fixed rate debt, 5-year term, agency financing, with 0% assumed growth in year one. That stuff has all the makings of a significant asset and market specific recession, right? And so that's my real answer, is that you would want to buy when all those metrics are cranked down. Now, of course, it's way harder to raise money when the metrics are cranked down, even though that's counterintuitive. But the reason is that's why they're cranked down, is because there's hesitancy in the market. So I don't know. I've done a lot of talking about this. I'd like to get y'all's perspective. I mean, you get where is that point connecting with you? And also, are you seeing the same kind of thing in your business?
Yeah. So I mean, we're definitely on the same page about all those things. I think the hardest thing to predict, because you're basing, like, this is a unique time where your rent bumps are so small. You're not putting in organic rent growth. You have a different risk profile completely with your capital stack. So that's like huge. And we've actually, in our last presentation, we pointed that out. We're like, hey, listen, this is the risk profile of a variable rate deal versus what we're doing now: low leverage, fixed rate, all cash for CapEx, all that stuff. So we've pointed that out. And I think that's something that's compelling to say. I think what we're still seeing are a lot of the people that were in those variable rate deals, whether out there that are getting hurt, they're still not warmed up to multifamily, even though we're showing all these things, we're pointing them out. They're like, I think I'm good on the asset in general. Hunter, what do you say to those people?
I mean, number one, I get it, right? Because if you got into the world of real estate and you're thinking this is an ultimate capital preservation play, and you invested with a group that had never lost money in 15 years, and then they invested in 10 deals and 8 of them lost money or something like that. I've heard these stories. You got to be like, this is not what I thought, right? And there's some truth to that. I mean, look, I learned that as well. It was not what I thought when I got into the industry, right? You try to be a better investor every year. That means at the end of the year, something isn't what you thought at the beginning of the year. And so for me, I mean, look, I was an evangelist for this industry. I still am. But like basically I was like, this is insane. Why did no one tell me about the fact that syndications exist? I can't believe that Wall Street's being lying to me. I can't believe my financial advisor lied to me. And that's all true. But like at the end of the day, there is risk in real estate. And in particular, when it comes to losing money, it almost always has something to do with the loan. And so for these investors out there, there's an emotional component, there's also a financial component, but it will eventually be revealed to them. And if they're listening to this show, it'll be very quick. I know an investor that, we did a deal with floating rate debt and investors received around, I believe it was 78% of their originally invested capital, which between you and I was basically a miracle given the situation. And, they were pissed. And they were like, how is this happening? I've done 11 deals and only one lost money. And so what the hell, basically? And I was like, okay, well, how many of your deals did you invest in that have floating rate debt? And they're like, one. I'm like, okay, that's the one that lost money because interest rates rose during the hold period. Now, I get it. And even if we were very clear about the fact that they were using floating rate debt in the beginning, which of course we were, it's still too much to ask for them to fully grasp that at that time back then. Here's why. And I'm getting a little technical, but like just play this out with me because this is what I did when I made the decision to invest in the deal. Okay, so 20 million, let me just use round numbers and this is from memory, but let's say it's a $20 million deal. There's $15 million loan. At the time, there was a 3-year rate cap and it was $30,000 to buy the rate cap when we bought it. All right. So I'm like, okay, 3-year period. We can implement this business plan, growing and robust thing. And by the way, if the rate cap expires, we can buy a new one for 30 grand. If interest rates go up, maybe it'll be 50 grand, whatever. Except for the fact that it was $500,000 in the 3rd year. Now, what does that mean? What is a rate cap? A rate cap is insurance that you can buy that it will basically create a ceiling as far as how high your interest rate will go. So who is the other side of that trade? The bank. Okay, so the bank sells you the insurance for 30 grand for a $15 million loan, something like that, if I remember correctly. And so who is determining what the market is for that rate cap? The smartest people in the room, my friends. Finance, the entire market, billionaire hedge fund managers, bond traders, the people that make the markets. And so you can't really blame a passive investor for not fully appreciating what might happen if the rate cap went up by 20 times. And so it's just the nature of getting into this game and learning from doing. You've got to learn these lessons. And by the way, in all fairness, I had plenty of mentors that told me I'm only doing deals with fixed rate debt and I want to invest in prime markets. Okay, cool. Makes sense. It's 2011. Now it's 2014. Now it's 2015. Now it's 2017. You can no longer do that unless you have a ridiculously low cost of capital, and you should probably put your money somewhere else at the time, my personal opinion. So now it's 2017. If you're going to stick with that model, you want to buy in prime markets and you only will use fixed rate long-term debt, you got 2 options. You can sit on the sidelines, you can put your money in bonds, or you can wait or you can do deals. And so what's the year that you start to question yourself? Like as a general person, is it 2017? Is it 2018, 2019, 2021? And by the way, everyone at this time is making money hand over fist implementing this strategy, right? And it's not even considered a high risk strategy. It's just a risk where you take the risk of the interest rate. So like, I'm saying all this to say, if you invested in a product like that and lost money, especially if you lost a lot of money, dude, it's not all on you. I mean, this is a hard to navigate game. You've got to give yourself some credit. This is difficult. Those bond traders also took the same trade because they were the ones that sold the insurance for 30 grand versus $500,000. So get back on your grind. You've got to make decisions with limited information. Keep the mentors that pointed you towards the right direction. Get new mentors where you need to, and keep freaking moving, because that's the way that you actually win the game.
Yeah, I think the sophisticated investors, the ones that are coming back, are recognizing what has happened and isolating it to essentially the financial markets, specifically related to the debt, separating that from the operator, because they are in fact
Yes.
separate. The problem
Yes.
is good operators, and maybe we consider ourselves one of the better ones. It's not helpful when you have to come up with $1 million to renew a rate cap of that you're a good operator. It doesn't solve the problem, whether it's at 95% occupied or 60. It does not matter. But the sophisticated investor recognizes that there's two separate things. There's something that's never happened before in history, isolated to this one thing. They didn't look at the operator. They look at the outlook of the asset class that we talked about here, and they are now putting the two together. Okay, this debt thing, this finance thing, probably not going to happen again. Okay, now I'm just looking at the asset class in general, fund, like you said, rent growth down in 26, et cetera, and now the operator, and they are now coming back into the market very, very slowly. And I think that's the key right now, is if the sophisticated investors, we're going to make a lot of money, I think, in the next 3 years, because we're going to get into these trades with fixed debt, low leverage, and in 2 years from now, in 27, when the market does explode and no one can get in, and now we're using higher leverage or floating rate again. Now we have these sumo loans or whatever the case may be. We have this fixed rate debt, low leverage. The equity buildup is going to be enormous, but it's very hard to convince people because they're still hiding in the cave somewhere.
100%, man. And that's the game. And that's why, I mean, what I talk about at raisingcapital.com is that you owe it to your people to be a leader in this exact moment. Like, if you are not putting yourself out there, being loud, being a louder version of yourself, if you're not creating content, if you've never done or been a guest on a podcast, if you've never put out a YouTube video, you're leaving money and influence on the table. And so this is a call to you. Anyone listening to this right now, I mean, every single one of you should be building your platform. And that doesn't mean you have to do an episode a week or 5 episodes a week like crazy Michael and his team. And I've done almost 1,000 episodes now, so I'm getting up there as well. But everyone listening to this should have 10 if you want to learn how to raise more capital. Every single person listening to this should have 10 podcast episodes on your website that will help your sales process. And I'll give you a quick example of this. If you've ever tried to raise money and someone has said they can't invest with you because of something, and especially if they've repeated it more than once and other people have given the same feedback, just take those no's and do a 8 to 12 minute solo podcast about it. And it'll just make your sales process easier, because people will go to your website and they'll see, is Phoenix actually running out of water? And you've got an 8 to 12 minute solo episode where you knock down that limiting belief. Here's another one. Should you invest when interest rates have risen? Or should you invest in prime markets versus tertiary markets? You can make your own decision about that. I'm just telling you, that's the kind of things people run into. And so if you have 10 of those, people go to your website, it boosts your credibility, it streamlines your sales process. It probably costs you $300 because you got a M7 Shure microphone, and that's it, by the way. And so, like, to me, this is how we get people out of the hell of, I lost money on my first deal, or I've never invested in real estate, why would I invest with you? It'll just streamline the whole process. And basically, it's going to be a requirement going forward. Because if people like Nighthawk are talking the way we've been talking, meaning it's been challenging for them, it's for sure going to be challenging for you. But this is how you do it, through building a platform, creating content, and using systems and processes and automations. And that's the name of the game going forward.
Dude, I've enjoyed jamming with you, man. It's been amazing. Key takeaways for me is, let's go. It's an incredible opportunity ahead of us, but it's difficult to see when the last couple of years have been a bit challenging. But where can people go to find out more about you?
One place, Phoenix, in February 19th to the 22nd. We have an event coming up called Raise Fest, and it's going to be awesome. I'm speaking, Cody Sperber is speaking, Pace Morby speaking, and a bunch of other hedge fund managers, billionaire capital raisers, total rock stars, people in our community. Hope to see you there. raisefest.com.
That's awesome. Great. Well, thanks again for being on the show.
Thanks a bunch.